Are you looking to relocate to a warmer climate? Jack Krupey is an experienced real estate executive focused on investment and asset management of a broad spectrum of asset classes. He participates in real estate partnerships in the multifamily, self-storage, mobile home, and private lending industries. He moved his business and family to the beautiful island of Puerto Rico. He will tell you about the different tax-saving benefits of relocating to Puerto Rico, as well as the beauty and lifestyle on the island. Find out why some people are referring to Puerto Rico as the new Silicon Valley.
Hello, Jack. Welcome to the show. Let's get rolling by giving us a brief background about your investing experience and what assets you are in today.
Sure, great. Joe, thanks for having me. So I've been in real estate since 2001. Originally I have a degree in information technology, but I graduated during the dot-com crash. So started kind of getting into real estate just because there wasn't as many opportunities in what I thought was my chosen field. And within a year or so, I ended up quitting my job and starting buying and selling properties in Rochester, New York, where I went to college. I was flipping houses, became a broker, was wholesaling, really all the traditional real estate types of strategies until 2008. And during the crash, I had an opportunity to work for a private equity fund in New York that was buying non-performing mortgages. So that was my first foray into the distressed debt space, and it was a space I've continued in over the last 10 years, and was fortunate to be able to scale a company to a pretty significant size.
That's awesome. I mean, I know that we met somewhere back in 2011, 12 at a conference. I mean, there's been many conferences. Is that how you got into the note business, or how did you get, first introduced to it?
Sure. So yeah, the first foray was actually a job. So at the height of the financial crisis, I was at a fund that was buying non-performing seconds for pennies on the dollar at the time. And I know you've got a ton of experience in that space. So I was there about a year and a half, and I learned the business there. They needed someone who'd had real estate experience to handle the short sale inquiries, loan mods, et cetera. So, but once I learned the space and I saw the opportunities, being an entrepreneurial guy, I left and went on my own and started raising just some friends and family money to participate in the market myself. So I was buying loans from that fund and some other smaller funds that would resell individual loans into the space. So I ended up focusing more on the first mortgage side of the business, just because the capital I had raised was just more traditional real estate guys that understood, from doing private lending and other real estate ventures. They understood being in first position. They were a little bit apprehensive about the risks associated with second position. In hindsight, I wish I did more second position loans, but it was a great, I was really just organically started growing my fund and buying and selling loans. And that led to much larger opportunities just by having a marketing presence and selling loans. A private equity fund that had not really been in the mortgage space. They were in more of the credit card debt space. Wanted to learn more about the mortgage investment opportunities and approached me off of a LinkedIn connection. And that meeting turned into what turned into $3 billion of acquisitions between 2014 and 2020.
That's definitely pretty sizable for most investors, right?
Yeah, it's almost a different world at that point. Once you're dealing in the hundreds of millions of dollars, you're able to secure very, very inexpensive leverage. Interest rates in some cases sub 3% on a securitization. So it really changes the dynamics of buying and what you could pay for assets. And it was, I know, sometimes a source of frustration for some of the smaller buyers who wanted to buy from us when you are buying sort of with cash and without leverage. But it was an amazing learning experience to scale. We had over 30,000 assets at any given point, and 600 foreclosures across the nation. Dealing with hundreds of individual markets and realtors with foreclosures in various places. So it was amazing to scale to that level and handle the management aspect of hundreds of assets, even with loan servicing companies and a lot of support. The scale is still kind of mind-boggling to me. How many loans were passing through our system.
And what was your specific role or your duties there?
So, I was one of the founders of the prior company, and we ended up merging in 2015. So I handled, sales, business development, And a lot of the initial recruiting, I actually brought on a third partner in the company. I brought on because I knew him from a prior role. So, really overall deal sourcing, business development, and as it scaled, it became part of a larger team. And we had a lot of support from our parent company, that had the larger contacts with like the securitization market. So, it was really just overall executive role.
So I know you are a lot of people in the space. So guys that are buying a few $100,000. Obviously, guys that are buying hundreds of millions. What are the differentiating things that set apart the fund that's doing billions of dollars versus the little guys? Or how can the little guys, what do they need to do now or implement that may help them grow to that kind of scale?
Sure. I mean, I think, you got to put yourself out there, and you have to, I don't want to say, there's like an analogy, fake it till you make it, but that's not, I don't want to advocate that. But I mean, if your goal is to scale like that, you have to have enough of a professional presence to start having those meetings, meaning, don't approach a private equity fund with an AOL.com email address. Like some of the joker brokers I've seen sort of sending portfolios around. There's, a bit of, really just putting together professional materials and something that demonstrates your value proposition. Most larger sophisticated funds, family offices at this stage are familiar enough with the non-performing loan space. I don't think that was even the case in 2010. It was an industry that existed before the crash of 2008, but it really there wasn't enough product to really have the attention of a lot of the sophisticated players. So I think at this stage of the game, the family offices and higher net worth investors are aware of it. And I think it's demonstrating that you have both contacts and deal flow and enough operational acumen to help them execute on whatever strategy you're doing, whether it's buying non-performing first, seconds, or any other real estate asset class.
So presenting yourself professionally, and ultimately we'll say you have to have confidence in what you're doing, right?
Yeah, you have to have confidence in what you're doing, and you have to have enough of a team to make it work. I'm not, we talked about this before we went on. I think neither of us are excellent financial modelers.
Yep.
I can get around an Excel sheet, but I'm not going to build the type of model that my old firm and most of the large sophisticated firms work on. That's a certain skill set and a certain type of personality that can do those types of models. So you need to have a rounded out team. If you're a sales business development person, you need that strong operating partner. If you're more introverted and you're more of a number cruncher and due diligence person, that's great. But you need to have a partner or a salesperson that's going to be able to network and get deal flow so that you can you have loans to buy. So it's really the power team, if you want to use one of the old buzzwords.
Yeah, I agree. What I've learned over the last 10 years too is that, I think across multiple sectors now, it's sometimes much easier to outsource those to the experts or certain vendors, maybe until you get enough scale that it may become beneficial to bring it in-house. Do you agree there?
Oh, I 100% agree. 100% agree. And then one other thing I just thought of on the track record side, when I was raising my first fund, I was honest about my track record, but I also showed deals that I'd brokered that I didn't have a direct financial position in, but that I had sourced and sold to other clients, and that gave me permission to follow along with the deal. So many investors, it's a chicken and the egg scenario. An investor that's looking to get into a space, knows that by the time you have a really, really strong track record, you might be too big for them to invest. So it was very important for me to just demonstrate how the deals worked from beginning to end, even if they weren't fully mine. And any of the investors I talked to at that early stage were perfectly okay with that on, hey, I sourced this deal to a client and this is how much money they made on the deal. And I, was involved to the level I was involved, but it just demonstrates the full life cycle of the deal, even if it wasn't all your own money at the time.
Yeah, I know a lot of other players or, investors in the note space, they're always trying to source product. And over the years, I've noticed, through seeing you in person or Facebook or whatever it may be, that you're always traveling around the world and getting to certain events. Can you tell us how that has impacted and benefited your business?
Yeah. I'm a big proponent of just face to face, and obviously with COVID, it's a little more challenging. But there's just a different level of connection when you have a lot of time with people face to face. The impromptu lunch meetings, the panels, frankly, the happy hours afterwards too. It's a cliche, but a lot of business gets done there. A lot of business can get done on the golf course. So just the time, where you can spend an hour just in a random group sometimes, and just get to meet everyone and really dive into opportunities. That just is not gonna happen on a cold email or cold phone call. And it goes both ways. And I try to provide a lot of value too. I'm not always at these conferences just to pitch what we're doing. It's really how do we create win-win relationships? What are the other groups looking for? Are they looking to source deals? Are they looking to sell? Are they looking for referrals or help with how did I structure something? I've always been very much an open book on my my goals, my strategies, and I've always thought of a rising tide lifts all ships.
Yeah. And so for all listeners, just to reiterate, I mean, as they say, the network equals the net worth, right? I mean, the people that you meet out in this world make an impact on everything in your life. Do you agree there?
Oh, absolutely. Yeah. Fortunately, this aspect of the game has always been fun for me. I enjoy meeting new people, hearing their stories, and strategizing on how to help each other. So, I know for some, my wife's a little more introverted and she's very social, but it's actually I think can be a little more tiring or overwhelming. Whereas me, you put me in a group of 50 people, I want to meet everybody and, get to know everybody. So, it's very valuable. And, for those that aren't as social, I mean, it's worth putting the effort in because it'll pay you back tenfold.
Now I know, I guess after, working there at the fund now, recently you moved to Puerto Rico, correct?
Yeah. And I got to thank you. You and you were the first person I knew that moved down. And I got to say, I was even a bit ignorant. I didn't know that you didn't need a passport to go to Puerto Rico the first time. So I thought I had questions, but.
Sorry, a lot of people sometimes don't even know that it's just dollars or it's even part of the U.S. I mean, it's very interesting. Growing up, you just never really spoke about Puerto Rico. I mean, it's just kind of a different world.
Yeah. And I still get questions of, is there power after the hurricane? I mean, yeah, I'm surprised. I'm shocked at still how many people are just really unaware of the territory. And it's a beautiful island. And, it's been an amazing place to relocate to. For me, being in New York, the second highest tax state, it became an opportunity to really kind of improve my lifestyle. New York, Manhattan was amazing, but it was an amazing place to get started. And I don't know that I could have been involved in a multi-billion-dollar fund if I was living in the Midwest somewhere. I mean, I think you have to have that proximity when you're trying to grow something large. But it does wear on you. Both the kind of the work culture, the just grind of it, the commute, the taxes and the high cost of living. You can make really great money, but 50% of it goes to the government, and of the rest, you're spending thousands a month on an apartment. Everything's more expensive. Just going to the grocery store, everything is just built into the higher cost of living there, and eventually it wears on you. So Puerto Rico was it wasn't just the tax benefits, but the tax benefits also contributed to being able to live a much higher quality of life, just by keeping some more of the money that I'm earning.
I think everybody's seeing it in the news right now, of this net migration or people fleeing these colder or high tax states and, getting out of these urban core areas. So, I mean, I guess you got out just in time, right?
Yeah, I think so. Especially with the first wave of COVID hitting so bad there as well. I guess I was a little ahead of the curve. You were very ahead of the curve.
Yeah.
At the time. I'm thankful. The other thing to me, like one of my favorite parts to go back to the networking is the types of people that have moved. I mean, there's a few thousand people who have taken advantage of the Act 20. So it's almost its own little Silicon Valley of entrepreneurs the difference is, these are entrepreneurs who've already made it. So there's a really, really interesting investment community here of entrepreneurs that have had enough success that it makes some sense for them to move their business here, and also enough of a sense of adventure to actually do it. I've talked to so many people that have been like, oh, I'd love to go to Puerto Rico, but I have, kids are in private school. I don't want to move, or my wife won't let me. And it's not everyone can do this. With that said, I know a lot of people who moved their entire families to Puerto Rico as well, and are extremely, extremely happy down here. You can live in a city like Condado, you can live in Dorado or Rio Mar and have sort of a golf course community at, a high-end golf course community or an average golf course community. So there really is something for everyone. There's rainforests, there's great beaches, surfing. So it's got really something for everybody, except skiing. If you're an avid skier, you just gotta, have a vacation home somewhere else.
So, it sounds like, from all experiences, Puerto Rico does have a lot to offer there regards to climate, different schools, restaurants, culture, everything. Can you give us a high level and just maybe some of the tax benefits people could expect to move in there and why one would?
Sure. So, originally it was called Act 20 and Act 22. They've rolled all these laws under a new Act 60, but the taxes are basically similar. So Act 20 is the business side of it. It's for export services, which is generally a pretty broad base of things that you do off island. It can range from consulting to marketing to fund administration. There's a majority of what you do offshore will count as export services, and that is taxed at 4%. There's a 4% corporate tax rate for that. And when you pass through your dividends to yourself personally, it is tax-free after that.
That's great.
So with that said, you do need to have one employee, which can be yourself. You do need to put yourself on payroll and take what they call a market salary. So you do pay a few extra percent, but your total tax rate's likely 7-8%, depending on how things are structured. It's a pretty amazing benefit. You do need to be here 183 days a year to take advantage of the benefit. Otherwise it would be no different than being on the mainland, because you'd have to repatriate the money and pay tax in the US. But if you're a bona fide resident of Puerto Rico and you're here 183 days and pass the closer connection test, you're tax-free, or you're at 4%. The second one is the Act 22, which is a personal exemption on short-term and long-term capital gains for Puerto Rico sourced income. That covers stocks and bonds and royalties or other, any other items you sell. The one thing it doesn't cover is real estate, because real estate taxes are sourced where the property is located. It can, in some cases, cover if you are running a fund and the carried interest from the fund, even if there is some real estate component. That is sort of it's a much more technical thing that you need to actually talk to a tax advisor about. But stocks, bonds, options. There's a lot of crypto traders that have moved down here, and there's a lot of full-time equities traders, swing traders, day traders that have moved down here to take advantage of those benefits. So there's a lot of smart people around me. I'm learning a bit about options trading now that I never bothered with before. But just given some of the tax benefits, it's actually been a fun little game to learn options trading.
So now that you're, located in Puerto Rico and you're set up to take part of the tax benefits and the awesome island there, what are you doing work-wise? Are you doing any consulting work, advisory?
Yeah. So when I left my prior firm, after my non-compete was up, I did pick up an advisory role with another prominent, larger mortgage investment firm. And so I helped them just overall business development, sourcing larger opportunities from some of the Wall Street firms, working towards getting kind of institutional lines of credit, potentially taking advantage of the securitization market. So on the kind of larger fund side, I still have one foot in that world. And additionally, I'd always wanted to set up a platform to have sort of my friends, family, associates be able to co-invest in our deals. Once we were part of this larger fund, they were raising money from pension funds and, sovereign governments. And, there wasn't an option to take 50 or 100,000 from the average investor. And I think there's not enough access to that in the market. I feel, and, I know a fair amount of just colleagues that, their money is sitting at, Morgan Stanley or Merrill Lynch or, TD Ameritrade. And, they're just trying to, the standard wealth advisors are saying, you put your money in stocks and bonds and you put 40% here and you try to make that 8 or 10% a year. And, the fact is on the alternative investments, the returns can be significantly higher. And there's also much better tax benefits, even for just the average investor. One of the areas that, in addition to the distressed loan investing, which I know super well and see significant deal flow, I've also personally been investing in multifamily apartment repositionings. And, especially when I was back in New York as a high income earner, the depreciation pass through becomes a major factor in investment returns. So, if you're owning a publicly traded REIT and you're getting a dividend that, may not even qualify for the lower dividend tax because some of the REITs don't take the tax up front, you may be paying 25 or 30% tax on your dividends, versus if you invest in a multifamily apartment syndication, you actually get your return of capital tax free because of the depreciation that's passed through. So, I don't want to get too technical on this, but there's a lot of advantages of the alternative asset space. And I'm actually formally launching my own Regulation D 506C fund that my colleagues can co-invest alongside me into various distressed debt, multifamily, potentially self-storage. It's really a pretty broad, diversified real estate fund that works with multiple operators in multiple markets to really give a passive investor diversification of their real estate assets.
That's great. So what is kind of your goals there for the next 5 years? What specific assets are you going to start with first?
So it's really going to be a combination. Distressed debt or reperforming loans is certainly a component of the space. The other key component is being a co-GP or co-sponsor of multifamily or self-storage deals. What happens in the market, and we're really focused on the middle market, so deals below $25 million in general, where none of the publicly traded real estate investment companies or larger institutional buyers are looking at deals of that size. So it's really a lot of what I'd call mom and pop syndicators. And they're always looking to raise a few $1 million and most of the time they only have 30 to 60 days to do it, because you get a building under contract, you have a certain time to do your due diligence and raise capital. So the real alpha, if you will, of this fund is that when a syndicator needs $2 million in 30 days, they're often willing to share part of the partnership with key investors. So we actually get a better deal than the average person would get. And these are off-market deals to begin with. These are private partnerships. So, if you're a doctor or a lawyer or, an executive, you don't have time to vet hundreds of these sponsors to figure out, who has a good deal, is the real estate a good deal to begin with? And then are the sponsors and the operators actually, trustworthy, successful groups? So just based on the 20 years of experience of contacts that we have, we have the whole system together, and we're aggregating sort of more passive capital into deals along with our own money to help provide capital to these operators to help them execute on their strategy. And they're happy to partner with us when they know they can make one phone call and get a majority of the funds. It's almost like we're a bridge lender, but doing it for equity as opposed to lending on debt. So, it's a great model, and it's not rocket science. It's really just leveraging the relationships and the connections. So I look at it as less risky than potentially putting money into a real estate investment trust in the stock market, where a piece of news could drop the price by 20%. So these deals are longer term holds. we're generally in buildings for 5 to 7 years, and whatever happens in the stock market or doesn't really affect the returns. We are very cognizant of COVID. The deals I've been in recently are still collecting 90 to 93% of their projected rents. There is some concern that once some of the government stimulus money runs out, that perhaps there'll be a further spike in tenant defaults. But in general, it's been more stable than I would have thought in March, both across the multifamily market and really the performing market as well. Our performing loan and portfolios, a majority of the borrowers that we're paying are still paying. The non-performing portfolios, one of the unfortunate things is, some of the loans that hadn't paid in 2 years already, there's been moratoriums on foreclosures. So some of the loans that were already in default are just have extended their timelines. And, the people that were already not paying have just got the benefit of additional time just because of the crisis. But, that's just, one of the natures of the business. And our goal was always to modify loans and help people stay in their houses if they can afford it. And, given the crisis, it just adds an extra variable to confirming if someone really has a hardship because of COVID, or they just, couldn't afford the house to begin with, or maybe should never have, if they bought the loan if they bought the property in 2006, we're still dealing with some loans where people probably, would not have gotten approved for a mortgage in today's standards, but pre-2008, it was a different world.
No, I agree there. And what I'm seeing even, people need to think about when they're doing a syndication, whether they're raising for real estate or even I see on the venture side is sometimes strategic LPs, and I'm sure like yourself, where they have background and expertise in what the field is, can bring added value to the deal, whether it's on a consulting side, help underwriting, or just go through any problems that, the deal may see over the years.
Oh, 100%. Yeah, absolutely. I mean, just as a random example, we're going to do a deal in Augusta, Georgia. And I just had a conversation a couple of days ago with a group that's based in New Jersey that has some multifamily all over the country, and they own another complex in Augusta, Georgia. So I'm bringing that deal as a first look to my operator that, is already under contract to buy a different building in Augusta, Georgia. So, the networking, the strategic partner is 100% true. And that's what I strive to do with, anybody I work with, whether they're a passive investor, whether they're an operator, whether they're just even a real estate broker, mortgage broker. It's always about finding the next opportunity.
And, beyond the real estate assets, are you seeing any opportunistic other alternative assets that you guys may approach in your fund?
So the fund is just by the nature of sort of disclosure of what we're going to do and not do. So this specific fund is likely to stay real estate. But I've also looked into other smaller funds, or maybe doing a separate fund that's sort of based on more alternative asset classes. One of the things I've done personally, I've invested in a startup called GearFlow through the Kellogg network. So I have I got my MBA last year. So I did the global executive program where Kellogg has partner schools in 6 different countries. So actually, coincidentally, these guys are from Chicago, but I met the one partner in Tel Aviv, Israel, during a venture capital class. And so GearFlow helps heavy equipment manufacturers sell their spare parts. And one of the founders has a family business in that market already. So they're really just adding a technology layer onto what was a very non-technology business. And they have a ton of demand, and they needed extra capital to fill out their website because their website was breaking because they had too many parts. So I thought it was a really cool opportunity. I follow the online business market extensively. I bought a few websites on sort of speculation, just trying to get a better feel of the market. And there's some interesting opportunities that, if you convert it to real estate, you can generally buy at a 30 cap. Granted, it's not secured by actual land, but in many cases, you're secured by an operating business. that's generating money through advertising revenue or subscription based revenue. So it's definitely a market I'm keeping an eye on. There's another market called search funds, where funds will actually back a entrepreneur to buy a operating brick and mortar business. Everything, it might be a roofing company or a garage door company. Yeah, these very simple brick and mortar businesses, but many of these businesses, when the owners are in their 50s or 60s and want to sell or retire and they don't have a family member to take over, there's really a need for executives that can take over and run these these great businesses, but they're not going to be the next tech unicorn business. So those are also the types of opportunities you can generally buy at a 20 to 30% return, and these are returns you're not going to find in a traditional market in general, unless you're a full-time trader that's actually really good. They say you can't really beat the market, but I just don't look at this as beating the market. This is just buying small cap, middle market businesses. And if you study Warren Buffett, a lot of their returns were actually the better returns. A lot of them were on the private side, not on the publicly traded side.
I think we're seeing that a lot more right now, or at least discussion around the news between the private equity and venture returns, or we'll call it more non-liquid tradable assets, having a higher return over a period of time. And I wonder how much of that is, the overhead and cost of being public, or just a matter of, sometimes being locked into an investment, you actually have to hold out for the duration. And sometimes the highest profitability is not made for years to come. So I think sometimes that helps that higher return. What is your thought?
Yeah, I think so. I think there's a premium for liquidity. So when you have the liquidity, people will pile into these publicly traded assets, drive up the PE ratios, drive up everything, and then they get overbought. But there's less access to these private deals, and it forces people to stay in for a longer period of time, and it becomes it's really just an operating business at that point, as opposed to a stock that may trade drastically different than what the economics of the actual company are.
Now, do you have any opinion on maybe what some of the opportunities are going to be on the private equity side, or these small businesses and or real estate, over the next 12 to 24 months with what we're seeing in the current economic condition?
Sure. So real estate wise, I'm actually pretty bullish on the residential side. I think that supply is going to continue to be limited. If you were thinking of selling your house this year and you don't have to for some reason, do you really want strangers walking through your house during COVID? The answer is proving generally to be no. So there's not as many new houses being listed. The foreclosures that we had that were vacant houses, they're selling very, very quickly. And in some cases, there's multiple offers. So, the people that have to buy, there's only so many houses to buy. And that single family market trickles down to the multifamily. There's not as many single family houses, so more people will stay in multifamily apartment buildings. Self-storage has generally been recession resistant. If people can't expand into a bigger house, they're going to need places to put their stuff. If the economy goes bad and people downsize, they need a place to put their stuff. So storage, I think, is a perennial asset class. It's a good diversification. Retail and office is going to be very, very challenging. There's going to be some opportunities. It's going to be market by market and case by case. To use Lower Manhattan as an example, I lived on Wall Street in 2008, 9, 10, and historically it was all office buildings. And just between 9/11 and just generally, the offices were moving more to Midtown, to these newer, larger buildings. There was just not as much demand for office space, and they converted a lot of those apartments to residential, and they doubled their cost per square foot by converting to residential. So in many markets, there's very well located office buildings or strip malls that might be better suited for a residential mixed use development with mostly apartments, but then a few retail stores that are, gonna survive regardless of how big Amazon gets. So I think there's going to be a lot of opportunity on that front, but it's going to be just case by case, city by city, and for for passive investors, I think it's a key to find an operator. These will be the types of deals that will be syndicated at, on a smaller scale where, I think it's find a good operating partner. And if you want exposure to that market, there's going to be opportunities. And on the tech front, yeah, I think what I described before, I think the search funds and the software as a service, I know a group that has a specific fund for software as a service where they buy operating businesses and they do everything. They help grow them and partner with the current operators, and they're going to, they continue to do that. And I think as more things move online, COVID basically moved everything 5 or 10 years ahead of what it might have done anyway. So it's been, it's going to be interesting to see how things continue to develop.
Yeah, definitely. I mean, COVID automation software, remote work, it's definitely changing right now. And it'll be interesting looking back 5 or 10 years out and just how things changed and maybe how the job market has shifted, from certain areas to other areas. Small business acquisition side, we're seeing a lot of talk, people just kind of coming on videos and talking about how much opportunity may be there, outside of even software, just small business, whether it's a service-based business or something, but there's going to be a lot of transition or generations moving on or retiring and selling their businesses. Do you see any opportunity there that you guys may participate in, or?
Yeah, I could see, I'm a huge fan of the search fund model. I think those are great opportunities because, a lot of these businesses you're buying at 2 to 3 times earnings. Those are, a publicly traded company you might be buying at, what is the PE ratio right now? 16 or 20 or something, some companies it's 100.
Yeah.
I think I love those deals. I don't want to tie myself to working 80 hours a week in directly in one business somewhere. I'm more on the aggregation of capital and finance side, but those are deals I'd love to be a passive investor in, whether it's through this fund or a different fund. I think that's a huge opportunity. And, for someone who has, more of a corporate background, but, has an entrepreneurial desire, but, maybe doesn't want to bootstrap and start from zero, I think buying a business to grow that already has some resources is potentially a much better avenue than trying to do a startup from scratch because, statistically, a very high percentage of startup businesses fail. But if you take over a business that, maybe has been managed well, but, maybe the owner has been very stable and just hasn't tried to grow the last 10 or 15 years because they're comfortable that it was working for them. But, buying something that already generates a reasonable return, gives you free cash flow, and gives you the ability to be entrepreneurial and grow it, I think is an amazing opportunity. And there's actually a lot of capital interested in those types of deals. So, and it's probably easier to raise money to buy something existing than to try to raise money to start something from zero, especially if you're not trying to start a unicorn. Venture capital wants something that can have 100 times returns, but there's different kinds of capital that are okay to buy a business that's going to spit off a profitable cash flow stream every year.
Yeah, I appreciate that. And so the last question we have here is, what has been the most impactful thing or the one thing that has benefited you the most to help increase your net worth over the years?
Yeah, I think it's really just kind of that almost just naive optimism, not naive optimism, but just I'm willing to put myself out there. There's always, I've taken calls and meetings that I didn't think were going to go anywhere. And you do have to be careful not to just distract yourself too much, but you never know where something. I've talked to potential guys that were trying to buy properties or mortgages from me that didn't have any of their own money, but wanted to learn. And then, a year later, they've partnered with someone and they've got $1 million, $2 million, and now we've done a lot of business together. So I think you gotta explore every opportunity and really put yourself out there and, make sure people are aware of what you're doing, what you need. One of the networking events I did through Kellogg, it's like when everyone got up and kind of gave their elevator pitch, it's like, give one need you have and one lead to someone else. So the one need and one lead.
That's good.
That's
I think
a great way to conduct.
I like that.
Business.
I like that. And so for all the listeners, if they want to reach out to you and learn more, about you, to connect or learn more about the fund that you're putting in place, what is the best way to get a hold of you?
Sure. So obviously, I'm on all social media. We've got a LinkedIn page. My website is JKAM Investments. It's short for JK Asset Management Investments. JKAMinvestments.com. I'm sure in the show notes you'll put the rest of email address, website, LinkedIn. I'm on a few of the there's various Facebook groups I'm on that deal with real mortgage investing, real estate investing, etc. And yeah, very accessible. The fund is by the time this airs, the fund will be live, and happy to talk with anyone and answer questions, and any possible opportunities as well, whether it's buying and selling of mortgages, properties, people looking for private loan, hard money loans. Really everything. Just reach out and we'll see if there's some synergies.
Well, thank you, Jack, for coming on today and also being a great friend over the years. I appreciate the relationship, and we look forward to seeing you again.
Absolutely. Thanks for having me.
Hey, everyone. Thanks for watching my latest interview. If you like what you saw, please click the subscribe button below to become a member of the Joe Robert community. Be sure to hit the bell to turn on all notifications so you always know when I post a new video. Tell me what you thought about the content in the comments below. I always read them and would love to answer any of your questions.